China's trade surplus has reached a record high, surpassing last year's total to hit $1 trillion in the first 11 months of this year.
$1 trillion, that's what China is reporting as its trade surplus tonight with the United States. That is a first that it's ever been so big. It tops anything before Trump's massive trade war and his promises to make China pay for it.
I put a 100% tariff on China.
China's paying us a tremendous tariff.
The Chinese economy, its trade surplus, has toppled $1 trillion for the first time ever, Brian.
$1 trillion, too, and we are not even to the end of the year yet. A trade surplus, of course, the difference between the value of goods that a country exports and the value of goods it imports. China's customs agency announced Monday that from January to November, the country had exported $1.08 trillion more than it imported, topping what was already an annual record for the entirety of last year.
China's going to be paying a lot of tariffs.
China is eating the tariffs right now. Right now, China's paying a 104% tariff.
This week, China released new data suggesting that, after a slight slowdown in October, China's exports returned to growth in November, taking China's total trade surplus this year to over $1 trillion.
The world's second largest economy has ramped up efforts to diversify its export markets since Trump took office again. It's been pursuing closer trade ties with Southeast Asia and the EU. Beijing had used Chinese firms' global footprint to establish new production hubs for low-tariff access. Customs data showed on Monday that China's exports grew 5.9% year-on-year. The data showed China...
For years, the world was told tariffs would slow China down. They didn't. Instead, China's trade surplus just crossed $1 trillion even under pressure from U.S. tariffs meant to do the opposite. Factories kept exporting, ships kept moving, and while Washington debated strategy, something unexpected happened elsewhere. Africa stepped in quietly, strategically, profitably. As global supply chains shifted, Africa didn't protest the trade war, it adapted to it, and in the shadows of the US-China standoff, a new winner began to emerge. This isn't the story people expected, but it may be the story that explains who really benefited from the trade war. When tariffs were first announced, the logic sounded simple: apply pressure, raise costs, slow exports, force change. The assumption was that China's export engine, one of the largest the world has ever seen, would stall under higher barriers. Reduced access to the U.S. market would shrink trade surpluses, manufacturing would slow, leverage would shift. That's not what happened. Instead of collapsing, China adjusted. Supply chains rerouted, export destinations diversified, manufacturing didn't retreat, it reorganized. And year after year, the numbers told a story that contradicted the narrative. By the time China's trade surplus reached the $1 trillion mark, it was no longer possible to argue that tariffs had achieved their central goal. The surplus didn't shrink, it grew. This wasn't an accident, it was adaptation at scale. Chinese exporters didn't wait for policy relief. They sought alternative markets, restructured pricing, and absorbed short-term costs to protect long-term positioning. Exports to some regions slowed, but exports to others surged. Southeast Asia, the Middle East, Latin America, and increasingly, Africa became more central to the equation. At the same time, something else was happening beneath the surface. Global companies eager to avoid tariffs began restructuring supply chains, sourcing raw materials and intermediate goods from new regions while keeping final assembly competitive. This didn't weaken China's position as much as expected. In some cases, it strengthened it, and that's where Africa enters the story. For decades, Africa was treated as a peripheral player in global trade, primarily a source of raw materials, rarely a strategic partner. The trade war quietly changed that perception. As tariffs reshaped costs, African exporters found new openings. Minerals, agricultural commodities, energy products, and intermediate inputs began flowing along newly emphasized routes. China, looking to stabilize inputs and hedge geopolitical risk, deepened trade relationships across the continent. These weren't symbolic deals, they were structural. Ports expanded, long-term supply contracts were signed, infrastructure projects accelerated not as aid, but as trade enablers. While headlines focused on tariffs and retaliation, Africa was being woven more tightly into global supply chains that no longer revolved solely around Western markets, and it happened without fanfare. No victory speeches, no declarations of alignment, just trade flows adjusting to incentives. The result was a quiet redistribution of benefits. While tariffs raised costs for some importers and disrupted established routes, they also created opportunities for regions that could step in quickly. Africa, with its resources, growing industrial base, and strategic geography, was well positioned to do exactly that. Meanwhile, the tariff strategy began producing unintended consequences. Elsewhere, consumers faced higher prices. Manufacturers dealt with uncertainty. Allies found themselves navigating a fragmented trade environment, and yet the central target, the export surplus, kept expanding. That contradiction is what makes the moment so important, because trade wars aren't just about punishment, they're about leverage, and leverage only works if alternatives don't exist. In this case, alternatives multiplied. China didn't retreat from global trade, it diversified it. Africa didn't challenge the system head-on, it integrated into the reshaped version of it. By the time the $1 trillion surplus figure became public, the underlying reality was already set. Supply chains had adapted, relationships had shifted, and some of the changes were no longer reversible. The biggest surprise wasn't that China survived the tariffs, it was that Africa benefited from them, not as a battlefield, but as a partner. And that raises a deeper question, one that goes beyond numbers and headlines. If tariffs couldn't stop the surplus, and if new players gained influence in the process, then who exactly did? The trade war empower? Because in global economics, the quiet winners are often the ones who shape the next phase. Trade wars are often judged by announcements, press conferences, and retaliation lists, but their real impact rarely appears in headlines. It shows up later quietly inside supply chains that begin to behave differently. That's where this story truly shifted, as tariffs reshaped costs between the world's two largest economies. Companies didn't wait for political resolution. They moved, not all at once, not loudly, but decisively. Survival mattered more than loyalty. Certainty mattered more than rhetoric. Manufacturers began asking different questions. Where can we source inputs with fewer political risks? Where can we diversify without sacrificing scale? Where can we secure long-term supply without sudden shocks? Increasingly, the answers pointed toward Africa. This wasn't an ideological pivot, it was arithmetic. Tariffs raised costs, uncertainty raised risk premiums. For companies operating on thin margins, exposure became a liability. Africa offered something rare in that moment: scale, resources, and flexibility without being at the center of the trade war itself. For China, the calculation was strategic. The trade war exposed a vulnerability long discussed but rarely tested: the danger of overconcentration. When access to a dominant market becomes unpredictable, the solution isn't confrontation alone. It's diversification. That meant finding alternative destinations for exports and securing alternative sources for critical inputs. Africa fit both roles. Raw materials such as copper, cobalt, lithium, manganese, bauxite, and mineral inputs, tied to advanced manufacturing, suddenly became even more important. Agricultural products and energy resources followed the same pattern. Many of these flows already existed, but the trade war accelerated them and fundamentally changed their structure. Spot purchases gave way to long-term contracts. Short-term logistics shifted toward permanent infrastructure. Arm's-length transactions evolved into integrated supply chains. This wasn't charity, it was insurance. Ports were expanded not as favors, but as throughput solutions. Rail corridors weren't built for optics, but to shorten delivery times and reduce exposure elsewhere. Industrial zones weren't symbolic, they were designed to lock in reliability. At the same time, African exporters found themselves in an unfamiliar position. They had leverage, as global buyers scrambled to reduce dependence on traditional suppliers. African producers were no longer competing solely on price. They were competing on reliability, neutrality, and availability. In a fragmented trade environment, those qualities became valuable. This marked a subtle but critical shift. Africa was no longer just responding to demand, it was shaping terms. Contracts became more balanced, payment structures improved, investment expanded beyond extraction into processing, logistics, and capacity building. The trade war didn't transform Africa into an industrial superpower overnight, but it accelerated trajectories that had already begun. Meanwhile, the Western response lagged. Publicly, leaders spoke of resilience, reshoring, and strategic independence. Privately, companies faced a harder reality. Rebuilding supply chains domestically was expensive, slow, and politically complex. Environmental regulations, labor costs, and permitting timelines stretched in 2 years. Africa, by contrast, offered immediacy. That didn't mean the transition was seamless. Infrastructure gaps remained, governance challenges persisted, but for firms navigating tariff-driven volatility, imperfect access was preferable to unpredictable access. and unpredictability defined the trade war era. What made this moment especially consequential was timing. The global economy was already under strain. Pandemic disruptions, energy shocks, and inflation pressures compounded the impact of tariffs. Each shock reinforced the logic of diversification. Every diversification decision weakened the leverage tariffs were designed to create. Once a supply chain reroutes, it rarely snaps back. Relationships form, capital gets sunk, skills transfer. Over time, what begins as a temporary workaround becomes the new normal. That's how Africa quietly moved from the margins to the middle, not as a replacement for China, not as a challenger to the West, but as a stabilizer in a fractured system. Ironically, this reduced the very pressure tariffs were meant to apply. As Chinese firms secured alternative inputs and markets, their exposure narrowed. As African exporters expanded their roles, their importance grew. And as Western buyers faced higher costs and fewer predictable routes, the balance shifted. This shift wasn't visible in daily headlines. It showed up in shipping manifests, procurement strategies, and boardroom decisions, and it reshaped incentives. Instead of isolating one economy, the trade war encouraged multipolar trade behavior. Instead of forcing capitulation, it rewarded adaptability. Instead of constraining global flows, it redistributed them. That redistribution carried political consequences. African governments long accustomed to negotiating from positions of dependency found themselves receiving multiple offers, competing buyers, competing investment proposals, competing partnerships. That competition mattered. It improved bargaining power. It changed deal structures. It reduced pressure to accept unfavorable terms simply to secure access. Quietly, leverage shifted. For China, Africa became not just a source of supply, but a strategic counterweight. For African exporters, China became one of several partners, not the only one. And for Western economies, the realization came late. Influence diluted faster than expected. By the time policymakers began discussing friend-shoring and de-risking, markets had already adjusted, and markets rarely wait for policy consensus. The $1 trillion trade surplus didn't emerge in isolation. It was the numerical expression of these adjustments. Exports found new paths, inputs found new sources, costs were managed. The system adapted around pressure rather than collapsing under it. What made Africa's role especially significant was that it didn't require confrontation, no sanctions, no retaliation, no declarations, just participation. By remaining flexible and transactional, Africa benefited without becoming a target. That's why the gains were described as quiet, not because they were small, but because they avoided backlash. Yet that silence carried weight, because once Africa became embedded deeper into global supply chains, removing it would be costly not politically, but economically, and economics tends to outrank rhetoric when margins are thin. As this new configuration solidified, one conclusion became unavoidable. The trade war reshaped global trade architecture far more than its architects intended. China adapted, Africa advanced, and pressure meant to constrain one economy ended up empowering others. The question now isn't whether these shifts occurred, it's whether they can be undone, and that question leads directly into the final act.